Is supermicrocomputer or SMCI the tech bargain of the decade? Or is it just a textbook value trap waiting to completely crush retail traders?
Oh, man, that is the million-dollar question right now.
Right, because we are looking at an absolute live battleground today. You got a stock caught in a brutal falling trend, bogged down by federal indictments, sell signals flashing everywhere.
Yeah, it's a mess.
It is a mess. Yet, at the exact same time, you have voices in the market screaming that it is severely undervalued. I mean, they're pointing to a massive, multi-billion-dollar order backlog.
Right, the Nvidia orders.
Exactly. So, for everyone listening, our mission today is to cut through all that noise. We've got raw financials, bleeding-edge order flow data, and analyst reports as of April 17th, 2026. We are going to figure out what's really going on here.
And you know, what's fascinating here is the psychological whiplash in the market.
Whiplash is a good word for it.
Yeah, because just a month ago, in March, we saw total capitulation. I mean, extreme fear. People were terrified. And now it's shifting into this incredibly tense, cautious optimism.
Which is exactly why we need to tear this apart. Real quick, if you're watching on YouTube, take a second to like the video, subscribe to our YouTube channel, and leave your thoughts in the comments. We want your feedback on this because the debate is incredibly polarized. Also, standard disclaimer, this is an educational deep dive, not financial advice.
Always good to remind people of that.
Yeah. So to start making sense of this, I want to establish exactly where SMCI stands financially right now. Let's look at the raw numbers. As of April 17, we were sitting at a stock price of $28.56.
Right.
But the 52-week volatility is insane. A high of $62.36 and a low of $19.48. That isn't just a pullback. That's, a complete dismantling of shareholder value.
It really is. I mean, when a stock loses more than 2/3 of its value, dropping from 62 down to 19, the entire psychology of the shareholder base changes.
I bet.
The institutional investors who bought at the top, they're completely underwater. So the new buyers stepping in at 19 are playing a completely different game.
Well, let's figure out how they fell from that $62 peak in the first place. Because if you look strictly at their fiscal year 2025 income statement, you would think this company was bulletproof.
Oh, absolutely.
Their revenue just exploded to $21.97 billion.
Massive.
Yeah, up from $14.99 billion a year before. They posted a net income of $1.05 billion. And the cash flow turnaround was incredible. Operations cash swung to a positive $1.66 billion.
Which is huge considering they were in a, $2.5 billion hole before that.
Exactly, a negative $2.49 billion hole. So on paper, FY25 was a triumph. Their balance sheet right now shows total cash sitting at $4.2 billion against total debt of $4.8 billion.
Okay, let's unpack this. Looking at these numbers, SMCI sounds like a sports car that just broke the core speed record for the year, but instantly started sputtering and stalling in the first lap of the new season.
That's a perfect analogy, actually.
So how does a company with such stellar FY25 growth miss so badly right out of the gate in FY26? Well, it comes down to the underlying mechanics of hardware scaling. In FY25, they perfectly captured the first massive wave of the AI infrastructure build-out.
Right.
When companies realized they desperately needed NVIDIA chips, SMCI was perfectly positioned to rack and stack those servers. They had the manufacturing capacity ready. But then we hit Q1 of fiscal 2026, which ended in September 2025, and they faceplant.
Yeah, big time. They missed revenue estimates by 15.5%, coming in at $5.02 billion. And their non-GAAP EPS fell 10.1% below consensus at $0.35.
Right, and suddenly Wall Street panics. Because you have to remember, this isn't a software company.
Meaning they can't just copy and paste their product.
Exactly. Scaling software just means spinning up more cloud instances. This is physical hardware. Atoms literally have to be moved across the globe. When you try to jump your revenue from $14 billion to $22 billion in a single year, your supply chain gets stretched to the absolute breaking point.
So component delays, shipping bottlenecks, that kind of thing?
Yeah, every single shortage of a specialized cable, it all magnifies. In Q1, they had the demand, but they simply couldn't convert those orders into recognized revenue fast enough.
So Wall Street looks at that and thinks, if you can't handle the logistics of $5 billion a quarter, how are you ever going to hit the $10 billion a quarter you promised us?
Precisely. The market reprices the entire future trajectory of the company.
Okay, that makes sense. But a supply chain bottleneck alone doesn't explain a stock dropping to $19. You can fix a supply chain. You can't easily fix what we were seeing in the bear case.
No, you definitely cannot.
Let's talk about the dark clouds. Because the biggest shadow hanging over SMCI isn't logistics, right? It's the courtroom. Co-founder Lai recently pleaded not guilty to federal charges in a massive $2.5 billion Nvidia server case.
Yeah, and this is where the fundamental analysis completely collides with institutional reality. You simply cannot overstate how toxic a federal indictment is to a stock's price.
Really? Even if the company's still making money?
Oh, absolutely. The massive mutual funds, the pension funds, the institutional money that actually drives the market, they operate on very strict compliance rules. Many of them have literal mandates in their charters saying they cannot own shares in a company entangled in federal indictments.
Wow. So they're forced to sell.
They have to, regardless of how good the underlying business is.
Which explains a lot. And it seems the insiders aren't exactly rushing to buy the dip either. Our sources show insider buying has been incredibly sparse in 2026.
Yeah, very sparse.
Plus, this comes right on the heels of the company filing notices about delayed filings and audit risks at the end of last year. But beyond the boardroom drama, there is something deeply wrong with the core business model right now. Their gross margins hit a painful low of 9.5% in Q1 FY26.
That's the real fundamental killer right there.
I just don't get it. If you were selling the most sought-after AI hardware on the planet, why are margins razor-thin at 9.5%? Shouldn't they have massive pricing power?
You would think so, but they are caught in a classic hardware race to the bottom. Yes, they're selling the hottest chips, but you have massive legacy heavyweights like Dell and HPE aggressively eating into the AI server market.
Ah, okay. The big guys are stepping in.
Right, and Dell has decades of entrenched relationships with enterprise clients. When Dell walks into a massive corporation and says, "We will build your AI data center," they can afford to slash the price of the hardware to practically zero just to secure the long-term service contracts.
Oh, wow. So SMCI is forced to match those slashed prices just to keep the orders coming in.
Exactly. And a 9.5% margin leaves zero room for error. If component costs go up even slightly, that margin turns negative overnight.
Man. So I'm thinking about the listener right now. You look at the stock that dropped from $62 to $28 and you think, wow, this is a massive discount. You assume it just has to bounce back. Can you explain the mechanics of a value trap and why retail traders are so vulnerable to this exact setup?
This raises an important question about market psychology because our brains are wired to anchor to that 62 or high.
Right, we assume that's the real price.
Exactly. We assume the drop to $28 is just a temporary glitch. A value trap occurs when a stock looks incredibly cheap, but the market has actually correctly priced in a permanent impairment.
Permanent impairment.
Yeah. The delayed filings, the federal charges, the brutal margin compression, those aren't temporary hiccups. They represent existential risk. The stock isn't on sale. It has been fundamentally downgraded.
But wait, here's where it gets really interesting. Because if everything we just said is true, if the margins are bleeding out and the federal government is knocking on their door, how on earth is this company still projecting $36 billion to $40 billion in revenue for fiscal year 2026?
That's the other side of the coin.
It's a massive contradiction. We just talked about a massive federal court case, but they have a $13 billion order book sitting right there on the table.
Yeah, a $13 billion backlog specifically for Nvidia Blackwell Ultra servers.
Their entire market cap is floating around the low 20 billions right now. Half their market cap is just unfulfilled orders.
It's insane, and it proves that regardless of what Wall Street thinks of their margins or their management, the actual end users, the data centers, still desperately want SMCI's product.
And from what I understand, a huge part of that is their market position in cooling, right? They hold a leading position in high-efficiency, liquid-cooled data centers.
Yes, and this is crucial. Think of these new generation AI chips like a nuclear reactor core.
Okay.
In a traditional data center, they cool the servers by basically blowing a giant desk fan over them, blasting cold air down the aisles. But these new Nvidia Blackwell chips run so hot that traditional air cooling is basically obsolete. Air simply cannot carry the heat away fast enough.
So if you just use fans, the chips overheat and throttle down.
Exactly, and you waste millions of dollars in computing power. So SMCI built the plumbing to run specialized cooling liquid directly over the chips.
So they were early to liquid cooling.
Very early. They have a massive engineering advantage over legacy players like Dell. It's a physical requirement to operate the future of AI.
That explains why the backlog is so sticky. Customers literally can't go anywhere else. Which brings us to the valuation metrics. The PE ratio, the price to earnings, is sitting at a historically low 21.77.
Which is wild for AI hardware.
Right. You usually see PE ratios of 50 or 80. Plus, intrinsic value models from Guru Focus suggest a potential fair value near $80. That's far above current trading levels. So how are investors supposed to weigh an $80 intrinsic value model against the very real threat of legal collapse?
Well, you have to realize that intrinsic value models like Guru Focus, they just run discounted cash flow algorithms.
They just look at the numbers.
Right. They look at that $13 billion backlog and say, if this company executes normally, it's an $80 stock. But the algorithm doesn't read the news. It doesn't know about the federal indictment.
Right.
If SMCI can somehow clear its reporting hurdles and navigate this federal case, the fundamental business is incredibly lucrative. The AI tailwinds are undeniable. But that if is doing a lot of heavy lifting.
It really is. So with fundamental arguments completely split between extreme bullishness and extreme bearishness, let's look at the charts. Let's see how traders are actually placing their bets right now.
The technicals are always the truth teller when fundamentals are this messy.
Okay, so looking at the trend direction, our sources describe it as a neutral to slightly bullish recovery, following a deep dead cat bounce from those March lows. Wait, a dead cat bounce? That sounds incredibly dangerous for someone buying the dip.
Oh, it's a widowmaker. The old Wall Street saying is that even a dead cat will bounce if you drop it from high enough.
Yikes.
Mechanically, a stock free falls, right? Down to $19. At that point, the short sellers, the people betting against the stock, decide to take their profits.
And to take profits on a short, they have to buy the stock.
Exactly. So you get this sudden, massive wave of buying that artificially spikes the price up. Retail traders see the green candles, think the bottom is in, and start buying too.
But there's no fundamental change.
None. And the moment the short sellers finish covering, the buying pressure vanishes and the stock collapses again.
Wow. Okay, so looking at the key moving averages, price is hovering exactly at the 50-day moving average, which is $28.52.
Yeah, that's a classic inflection point.
And there's massive resistance at the 200-day moving average up at $38.87.
Yeah.
As for support and resistance, we've got strong support in the $22 to $24 range. Near-term resistance is at $33, with a major breakout level at $35.
But you have to look at the momentum warning flashing right now.
The RSI, right?
Yes, the relative strength index.
It's sitting at 78.48, which is entering overbought territory. What does that signal for the short term?
Anything over 70 means the stock is hyperventilating. It's been sprinting too fast. At 78, the buyers are exhausted. It signals extreme short-term weakness. A pullback is almost guaranteed just to let the stock catch its breath before it can even attempt to challenge that $33 resistance.
Right. And analyst ratings seem to agree with that caution. The consensus is a hold with a 2.6 out of 5 score. Price targets range from a low of $22 to a high of $64, with an average around $35.65.
Which lines up perfectly with the technical breakout level.
But here is the crazy part, the options data. Market Chameleon shows traders are eyeing a gap fill to $35. And notably, open interest for call options expiring in May 2026 has surged over 500%.
Over 500%, that's massive.
What does a 500% surge in May call options actually mean for the listener? Are institutions quietly betting on a massive breakout, or is this just high-stakes gambling?
Well, a technical gap happens when a stock drops violently, leaving an empty space on the chart. Traders believe prices naturally gravitate back to fill the gap up to 35.
Right.
But when you see a 500% surge in call options concentrated in May, it means massive institutional money is front-running a specific catalyst. They are placing highly leveraged bets that the stock will violently fill that gap.
But wait, how do you reconcile that with the RSI? The options market is flashing bullish signals for May, but the RSI is screaming that it's overbought right now.
It's a war between timeframes. The short-term overbought RSI suggests traders should brace for turbulence immediately. We'll likely see a pullback to shake out weak hands before any real breakout to $35 occurs in May.
Okay, so let's synthesize this for the final verdict. Short-term versus long-term outlook. Short-term, over the next few weeks, expect volatile consolidation between $27 and $30.
Definitely.
Long-term through 2027, the AI tailwinds are undeniable, but only if the boardroom cleans up its act.
Exactly. To summarize the whole value versus trap dilemma, on paper, the stock is intrinsically undervalued. The liquid cooling dominance, the low PE, it's all there, but the legal overhang and margin compression make it an incredibly dangerous trap for those ignoring the risks.
It's wild. So the technical gap is pulling the stock toward $35, but the overbought RSI is flashing a warning sign.
A bright red warning sign.
With May earnings right around the corner, will the sheer force of a $13 billion Nvidia order book be enough to wash away a federal scandal? Or is this dead cat bounce about to run out of gravity?
We're about to find out.
We really are. Thank you for joining us for this deep dive. If you found this analysis helpful, please like the video, hit subscribe, and drop a comment below telling us if you think SMCI is a buy or a trap. See you on the next deep dive.